Hey everyone, welcome to the DuPont Identity. So with this identity, we get to assess three components: operating efficiency, asset management, and financial leverage of a company. So it's a nice summary of the financial performance. Now in this case, we are comparing three companies. Okay, so you can see I've got my data already copied over, but we're looking at Pepsi, Coke, and McDonald's. And we can hopefully see some strengths and weaknesses with all three companies. Now, before we get to the actual ratio, we are going to need a little bit more information. So, for some reason, they didn't give us the balance sheet and income statement because perhaps that would be too easy. So we still have to know or compute what the equity is. Now, since they've given us our total assets and they've given us the total liabilities, we can simply find the difference, and that will give us our equity. Okay, so recall our balance sheet. Our equities plus our liabilities should give us our total assets. So we can go ahead and figure that out, right? That's in millions, so they want us to continue in millions. So we will do that. Fantastic. Thank you. Wonderful. Okay, what else do they want? So now we need to actually start looking at the DuPont identity. Okay, and it starts with our profit margin. So we're going to recall what our profit margin equation is, or formula. And you know what, let's take, I'll keep it like that. Try and bring these companies back down here. Okay. So profit margin, well, it's going to be, you know what, let's move this over here. Profit margin is going to be our net income. Okay. Good, this is all in millions, so we can keep it consistent. We're just dealing with percentages, so we don't have to convert to anything. Okay, and again, when we're looking at profit margins, we're going to be dealing with percentages, so we just want to convert properly. Alright, so we have PepsiCo, Coca-Cola. Remember, this is that ability to control the costs. Okay, so how profitable are we? How much of our sales are flowing through to the bottom line? So it looks like McDonald's is quite profitable compared to the other industries. Let's move on to our asset turnover. Okay, so this is one component of the DuPont identity. We have to multiply, and basically we're going to multiply all three components and get our total return on equity. But our next component is our asset turnover. Okay, so if we look at asset turnover, starting back with PepsiCo again, we're going to take our sales divided by our total assets. So remember, this is how efficient we are with managing our assets, right? So, hopefully we invested in some, highly revenue generating assets. We didn't waste our money on, theme restaurants or spas that don't generate a lot of revenue. Anyway, sorry, what am I talking about? PepsiCo, maybe they spent too much money on, equipment that doesn't work. And I'll keep that to myself. All right, so we can keep that. Looks like we want to keep that, of course, decimals, but we just want four decimal places. Okay, so if we start thinking about the actual equation, we're going to be basically multiplying these two. So I'm just going to do that. All right. So let's punch those in. Okay. And what's nice about this is we can start to see some of the strengths or perhaps areas for improvement, specifically in these three components or these three areas. Now, DuPont's made a lot of wonderful things. They've also made something very terrible, which was Teflon. But anyway, let's move on. All right, and finally, we're going to take a look at our equity multiplier. So again, we want to know, this is interesting because this really helps us understand how much of the assets are going to be financed through equity versus through debt, okay? And I'll explain this in just a second, but let's just get our formula down here. Okay, so equity multiplier. Here we go. Okay, so again, this is our final component that we're gonna multiply by. So again, we are multiplying, and then it's gonna equal our final ratio. Okay, oops, get rid of my drawing. Okay, so let's move on to our PepsiCo's equity multiplier, total assets. Divided by our equity. And we'll bring this down. And before we talk about this, I just want to, just so we can sort of see this in terms of percentages. Now, remember, our assets are financed through our liabilities and equity, all right? Now, if we need or we use more equity versus our liabilities, then that would mean that there's a higher percentage of our equity being used to finance our assets, right? So let's look at what that means, particularly in this case. So we have our equity and liabilities again, but we just want to see it in a way we're trying to use it as a common size ratio. Okay, so in other words, how much of our equity are we using to finance our total assets? Okay, so we'll bring that down. And this is consistent with our equity multiplier. Okay, so in this case, now we're going to see how much of our liabilities are we using to finance our assets. Okay, so if we think of these as percentages, right, and ultimately we should be, if we add them together, it should be equal to 100, right? So in other words, 100% of our equity and liabilities is used to finance our assets. So, and this helps us sort of understand the equity multiplier. So if we take a look at these numbers here, we see that PepsiCo has the highest equity multiplier. Well, what does that mean? That means that they're actually using less equity to finance their assets. So in other words, they're leveraging more debt. Okay, so they're leveraging more debt to finance their assets. Now that's good for the owners. Okay, in other words, they're using less of their money to finance their asset. They're using debt instead. So that's a good indication for the owners. However, of course, if you use too much liability, if you use too much debt, you're also increasing the value of risk. Okay, so in a way, it's a firm's management of risk as well. So you can kind of look at it from both point of views. Okay, again, open to interpretation. So finally, let's punch these all in. So again, in this case, they want 4 decimals. All right, so finally we want to actually compute the DuPont identity, okay? In other words, find the ROE in this regard. So we are going to take the product of all three of our components, and we will figure out. And again, just to reminder, okay, so this is what we're doing. Taking our profit margin times our asset turnover multiplied by our equity multiplier. Okay, and that's going to give us our return on equity as indicated through our DuPont Identity. Let's put that in the proper format. So it looks like they want percent. Okay. So 27. So again, this is a sort of summarized version, an overall return. Okay. And we can see that, McDonald's has the overall advantage, right? But we can also identify components where there may be not number one, and recognize other companies that have an advantage over McDonald's in other areas. Okay, so take a look at that when you're considering answering this question. Thanks for watching, and happy financing.